Hey everybody, welcome. Thanks for joining us for another episode of Weekly Success Builder. I'm going to give it just a minute here so that we can let everybody cycle in. I know this is a hot topic for everyone, and so we're very fortunate today to have Jason Dickinson with CIC Credit on to give us as much information as he's able to give us. And I'm sure we'll have some questions at the end on what Vantage Score is going to look like. So as folks continue to cycle in, we're going to go ahead and get started because I want to make sure that, I try to be mindful of everyone's time and keep it at 30 minutes. So Jason, thank you so much for joining me today. Greatly appreciate you taking time out of your day to offer this information to us.
Thank you so much for having me. I appreciate you, Valerie. Appreciate it.
Yeah, you're welcome. So let's kick it off.
Yeah, so Vantage Score is about a month ago. There's kind of a surprise announcement on X by the FHFA Director Bill Pulte. And by the way, my name's Jason Dickinson. Like she said, I'm with CIC Credit Reports. I'm a senior account executive here, and we've been given a little bit of information, and a little bit of information's out there about Vantage Score 4.0. And so I'll just tell you what we know, what we don't know. Time will tell on a lot of things. We're still being given guidance on a lot, but I will kind of give some information and squash any misnomers that are out there. So the announcement was made a little over a month ago. He said, we're making credit score industry competitive to benefit the American people. Here are answers. We deliver choice for the American people. And overall, this may be beneficial down the road. I've been getting a lot of phone calls about Vantage Score 4.0. Mortgage companies are calling us. We work with thousands of mortgage brokers and mortgage lenders and banks and provide them with their credit reports here at CIC Credit. But the answer is it's really not ready yet. So it's, maybe tomorrow, maybe next year. We don't know the answer when it will be ready, as it was a little bit of a surprise announcement and caused a little uncertainty. So we'll find out soon, and we'll let you know when all the answers are here. But we do have a lot of answers on what 4.0 from Vantage is all about. And I'll dive into the next screen.
Yeah, I did hear, Jason, by the way, and correct me if I'm wrong, that basically all of the credit providers, you folks, found out this announcement along with everybody else when Director Pulte posted it on X. Is that correct?
That is true. That is true. Yes, we have the Vantage 4.0 score. We do deliver it. We work with a few non-mortgage companies, equipment finance companies, things like that, and they do purchase the Vantage Score 4.0 from us. But in the mortgage world, it's there, sitting there, not really usable too much to you. So we did find out when everyone else found out. That's 100% true from what I've heard. Yes.
Okay, awesome. He likes to keep us guessing.
Yes.
Good or bad.
Hey, and maybe this will just get the ball rolling faster than it possibly would have. So we will see. Time will tell. Why are they making these changes? As we all know, we're pretty transparent. The FICO score has gotten a lot more expensive the past few years. So I think price drove this a lot. And hopefully this causes a little competition within the scoring models delivered to mortgage companies. And hopefully, I think one thing we haven't talked about a lot is a new predictor of default risk. And, will this improve risk management, or will it help qualify more people for loans that weren't able to be qualified before? We'll find out. We'll find out more about Vantage 4.0. I think these are all reasons why it's being pursued as an option. It's always nice to have multiple options. Having one provider for any service sometimes raises questions, especially if the price does increase dramatically within the course of a few years. And Vantage 4.0, to its credit, isn't just out of nowhere. It has been tested by the enterprises since 2022, and it's been around since 2006. So it is, an established company, an established joint venture, I should say. And you may have heard of Vantage 3.0, which is delivered to consumers from like Credit Karma, things like that. is Vantage 3.0, not to be confused with Vantage 4.0, which is a different scoring model. So if you want to go over to the next one. But yeah, I think price kind of spurred the talk about it, but it could bring other benefits possibly. So I'm getting a ton of phone calls from mortgage companies, brokers, and lenders alike saying, Jason, sign me up. Let me have the Vantage 4.0. But honestly, it's just not ready yet. The score is there, but the technical integration, loan origination systems, ones that you most likely use, they need to make adjustments in their system. The AUS systems, Fannie, Freddie, DU, DO, LPA, they need to make some changes to accept the Vantage score and make changes within their system. And companies like mine, third-party CIC Credit, third-party credit reporting agencies like CIC and the others, they need to be given a little guidelines on how to deliver these scores. So it's just not 100% ready yet. Can someone get it? Yeah, yes, but it's not really usable in the real world realistically right now. I have another question down there. Will lenders report credit scores from multiple, if you can go back real quick, from multiple models? We do know, when I said, how do we deliver these scores? Do we deliver all 6 scores, 3 from Vantage and 3 from FICO? We don't know. Will lenders are given a choice. Will lenders say, we want these scores or we want that score? We don't know. We just don't know exactly. We do know that lenders have a choice, but you can't mix and match currently. You can't mix and match. Like I like the Vantage score from TransUnion, but I like the FICO score from Experian. That won't be allowed at this time from what we know on a credit report. So we're all looking for guidance on how to deliver this, how to receive them, and how lenders will accept them. There are differences, so Experian, Equifax, TransUnion, you get a score from each of them. You get the TransUnion 4, the Experian version 2, and the Equifax Classic or 5 score from Equifax. Each of the 3 bureaus with Vantage 4.0 will deliver a Vantage 4.0 score for each of the 3 bureaus. They do both go from the same numbers, but the percentage, you've seen the pie chart probably for the FICO score, 35% for payment history, 30% for utilization ratio, and on, you can see on the screen. Vantage 4.0 puts the weight a little more on different items, and they even have other things they rate in their score. So that'll be a little different, and we can dive into the details of what all this means separately, but it does take the same information from Equifax, from Experian, from TransUnion, and uses different score factors to give you the score. If we can go to the next screen, I'll tell you more about that. Like I said, they do both go from 300 to 850, but the score model takes things into consideration a little differently. I think Vantage Score 4.0 is a little more considered consumer friendly, if you will. A consumer only needs 1 month of credit history to generate a score, where if you've seen FICO scores in the past, someone who with a thin file, maybe a really young person, for example, who doesn't have any credit history, it takes them about 6 months to get a credit score with a credit card. So that's very good for younger borrowers or people who just don't have a lot of credit history. Maybe someone who just came to the country who's trying to establish themselves with a credit score. Vantage Score ignores, from what we've been told, all paid collections. So if a collection is there, it's been paid, 0 balance, apparently it doesn't count in their score formula. Whereas FICO, a paid collection is usually, hurts the score just like an unpaid collection. Medical collections is kind of an outlier on that. 0 balance medical collections, really at this time should be deleted from the bureaus altogether. So there are differences. Maybe it will be a little more consumer friendly. Is that a good thing for predicting default risk? We'll see. Time will tell on that. We can go to the next slide. And do you have any questions, Valerie? Anything you thought of that?
Yeah, I was gonna let's just go back to this slide. You
Hmm.
know, looking at this, it kind of what would obviously be beneficial on the mortgage side is if you have a borrower that you have pre-qualified or that you've been working with, and the wholesale lender does give you a choice of FICO or Vantage. Um, as you mentioned, if you have somebody that has newer credit, obviously Vantage would be more advantageous to the borrower because it's not going to take as long for them to get a score. Also, it looks like, they've got another added item in here. Uh, it does credit mix on the FICO side represent what is that mix comprised of? Because, you don't have like, it's not apples to apples on how they're weighing certain factors um between the two, because you've got like age and mix of credit uh
Hmm.
20% on Vantage side, but credit mix 10%, and then you've got available credit and credit balance on Vantage, which isn't on the FICO side.
Right. I'll have to look and see and do a little research on what that means. It could possibly be a hybrid of the FICO, credit utilization ratio and credit history, just worded a little differently, or maybe there's some variations within there of what they're considering age and mix of credit versus credit utilization. We'll find out a little more on what they mean exactly. I haven't dove into exactly what their definitions of that is. Um,
Yeah,
so
we were talking earlier, where everybody is very focused on cost, but based off of this, it might be more advantageous for the borrower or the mortgage company to spend a little bit more money if you do have the ability to kind of look at both and
right.
see which one benefits the borrower more, especially if you have those ones that are on the borderline. Um, yeah, so you really may not be saving money. You might be spending more money. Um, it,
Yeah, and that we'll see if that's the guidelines. If you're able to purchase, three scores from FICO and three scores from Vantage on the same report, we'll see if that's an option. And then if it is, you would be spending more money. Exactly. And can you get rid of scores once you see them? That's something that we'll find out down the road for sure.
and that was another part of our conversation, because when I think of Vantage, and it just may be because they were announced together, I think of buy merge, where you're getting still three scores from a score from each bureau. They're just weighting them differently.
Yeah, I don't know. I don't have all the details on the buy merge. Buy merge I think of as a two bureau report. So I'll have to find out what other people have different definitions of buy merge. So I'll see if that's more of a two bureau report or a two, score report, or, six scores basically, because it's three bureaus times two.
Right.
Lots of talk on changing it, but I think that was brought up to have one bureau or two bureaus, but that was denied recently. So the tri-merge is still the tri-merge, all three bureaus is still the industry standard and what's accepted by Fannie and Freddie at this time.
And then we were also talking earlier the cost.
Mhm.
So I think some of us, obviously we don't know what the Vantage score cost is going to be. It's presumed that it's going to be cheaper because you don't have the extra layer of the FICO fee on top of it, but you were saying that they're both basically the same.
Yeah, we're pretty transparent. We get costs from the bureaus and the score model companies, and completely honest, the pricing is pretty much the same for Vantage Score versus FICO Score. Um, Now with this new acceptance, will this bring competition? I would predict, in my opinion, this would bring competition and they could lower the score. Will that happen tomorrow? Probably not. But currently they are the same. I would think this would bring some competition to a lower price within the score part of the report, within the bureau, the data of the three major bureaus. I don't know what that's going to do with that, but within the score portion of the credit report, yeah, I would predict that would drop the score. I think that was the point of it, and that typically does with some competition.
Right.
Time will tell. We'll see. I don't have any solid information on that.
Yeah, absolutely. And as Jason continues, if anybody has any questions, please feel free to type those in the chat, and we'll definitely look at those at the end. And I did see a question, is this being recorded? Yes, this is being recorded. It'll get posted in the Hive later this afternoon. So you'll be able to go back, look at this information. And Jason, is it okay to post your, oh, you got the last slide is Jason's contact info. So if you need to reach out to Jason directly, post this call. Hopefully we don't inundate you, or maybe that's a good thing if you want to be inundated.
Inundated way. The easiest email is jason@ciccredit.com. JASON at CIC, the word credit.com. 2 C's in the middle. Happy to answer any questions. And going back, you don't have to go back, but regarding the score formula or how the score is made, we will have a score simulator. You know, we have 3 score simulators now for the FICO score, Credit Expert Score Navigator. FICO has a score simulator as well now to simulate, you know, like you probably use these for 10 or 20 years on the different score simulators, how to increase it based on if you pay a balance down or remove a late or remove a dispute. I know Score Navigator has a formula for the Vantage Score also, so we can simulate that. I've heard the other score simulator tool we use is going to have the Vantage Score simulator as well. So we'll be completely prepared for score simulators for the Vantage Score as well, which is great news.
Yeah.
Kind of foreshadowing to what's needed.
Since we do have a question about cost, and we'll just since we're talking about that just a moment ago. So the question is, why has the cost gone from $34 for a joint report to $109 in less than 3 years? He says no one's been able to answer the question. So we'll see if you're able to answer the question. So
yeah, I answer the question all the time. I mean, we're a third-party credit reporting agency. We get price increases directly from the bureaus and from FICO, and they send every credit vendor their new cost at once per year, and we have to take that cost and then increase our fees based on what the bureaus give us. So, you know, just like anything with pizza, if the price of cheese goes up, the price of the pizza goes up. Kind of similar aspect to it on any service. So our cost went up from our providers, similar to VOEs. The price of verification of employment went up, so our cost goes up. We basically take the information, package it, and sell it to you. So, did our margins go up as a third-party credit vendor? No, not at all. But our cost has gone up dramatically.
So the question is why, but to me, these are 3 for-profit companies. If they want to increase their fees, just like the cost of a slice of cheese, they don't necessarily have to have a reason.
That's true. That's exactly true. We don't know the reason either. You know, we aren't given a reason either. We're given a letter once a year from each of the 3 bureaus and all our providers, and that's what it is. We don't have the reason either.
Yeah, I think sometimes, you know, it's hard we're so used to dealing with government and regulatory agencies that we think of the bureaus as another agency, but they're really just 3 for-profit companies.
Yeah, 1 or 2 of them are publicly traded, and yeah, I think one's publicly traded, the others are private companies. But yeah, they're not government agencies whatsoever, so they can do what they would like to do. And some of them, you know, say they bolster their security, they bolster their information, they bolster their data, they give more data. They have a lot of other pieces in there, but we don't have a reason. So I can't really speak on their behalf of why they've increased the cost. We're not the 3 major bureaus. We're a third-party company that provides their information to you, but we're given their cost and we provide it to you. So,
and there is a question, could the cost be proactive because of trigger leads? And I don't believe that's the case. I mean, you can correct me if I'm wrong, Jason. I do know just from all the work that I've done on trigger leads, there's really only one bureau that gets the majority of additional ancillary income or revenue from trigger leads, and I believe that's Equifax. And it isn't, the trigger lead situation doesn't eliminate their ability to sell leads on all other kinds of financial related products, whether they're student loans, insurance, auto loans, whatever the case may be. I believe Experian makes their highest amount of revenue from lead selling is off of insurance, which is not affected by the trigger leads bill. So I don't think that has anything to do with proactively looking down the road of what that may look like, because they're not all they don't everybody isn't doing everything exactly the same.
Yeah, just like any other company, they have many sources of income, and trigger leads is one of them. And these reports they sell to mortgage companies is another one. And they have many other parts of their business that they, sell as well. So I don't think those are related. Possibly they are, but I don't think so. And when trigger leads, hopefully they do go away if they get signed. I think it has 6 months until that gets signed. That's a whole nother webinar we could do. But it looks like it's on the president's desk to be signed, and it'll take 6 months to implement of getting rid of trigger leads, hopefully. We don't like trigger leads either. We are here for the brokers and for the lenders. We want you to succeed. And if trigger leads hurt your business, it hurts our business. So, but the price of credit reports, I haven't seen any correlation between those two.
Okay, great. All right, so we'll let you continue on rent history, utility history.
Yeah, getting a lot of questions about rent history and utility history, because that was kind of mentioned as one of the factors Vantage 4.0 has. And it's just a little more complicated than simply all rent can just be reported to the bureaus and now it's going to help the scores increase. At this time, like individual landlords who have 1 or 5 or however many rentals that they have, they can't just simply report a small amount of information to a database. There's third-party companies, rent reporting services that get, large rental companies, apartments, whatever the case is, to report a high minimum number of rentals to them. Some of them charge a fee to these companies, and it's collected in a database that's, shared somehow to the 3 bureaus. We don't really have the answer on how much this will help the score. We just don't have all the answers yet. So we're looking on guidance on how rents will affect the scores on Vantage 4.0, similar with utilities. TransUnion has eCredible. Experian has a very popular tool called Experian Boost. That only affects currently FICO 8. So if you look on the fine print for Experian Boost, that's only affecting FICO 8. And mortgage companies can't use FICO 8. You can use, like I said, Experian version 2, TransUnion FICO 4, Experian or Equifax Beacon or 5.0. So we don't know yet how it's going to affect the scores at all, but it is interesting. Hopefully it does help if it can qualify more people. If you've paid your rent on time for a long time, a lot of people will argue that's a good determining factor on how you're going to pay your mortgage. But as of now, there's still questions on this. So we'll find out. But it is interesting to talk about it, and an interesting service if it is successful. So when, like I said before, there's really no set time frame or ETA. We need guidance. We need the LOSs and AUSs to have all their technical portions intact. I'm sure they're working on it right now. But yeah, so this call was kind of to talk about the misnomers with everyone thinks it's going to be instant right now, a lot less expensive, a higher score, and those are all just not 100% true. We don't know when it's going to be. Currently, it's not cheaper. It may be soon. And are the scores higher? We just don't know. So we are looking into it. We're doing our best to learn this information. It's only been a little over 30 days. But as we find out more, we will definitely let you know. I think right when this announcement was made, I was contacted by NAM and by a couple other things, and we wanted to have a talk about this right away. And I said, we have to wait. So it's been 30 days, a little over 30 days now. We still don't have all the answers, but it's a little more clear than it was before. And I'm sure we can do an update on this a month or two, or whenever we get more information, I'd love to do an update and give you more information about this. So, because I think it will be a good thing. Hopefully it is cheaper. Hopefully it is a better predictor of score, and that will be fantastic. So we'll keep you updated. We'll let you know, and we'll go from there. I think the next slide will probably be my contact information. Happy to give you information. Happy to offer any guidance and keep you updated. We can email you directly with any information if you'd like. And any other questions? I didn't check the chat recently. Looks like there's 8. Yeah, any other questions?
Sorry, let me unmute myself here. Are buy now, pay later going to be factored in the future?
Buy now, pay later. I don't know. I'm not sure. Okay. I'll ask. I don't know who to ask exactly, but if we get a conversation going with Vantage, I'll ask them.
Since we've got a couple more minutes, and if anybody else has any questions, please feel free to type those in the chat. There's been a lot of discussion about going to a single bureau.
Mm-hmm.
NAM, we started the conversation earlier this year. MBA has the conversation now. Obviously we're not credit experts. We're, users of the product.
Right.
But on the outside looking in, it appears that the information that the 3 bureaus are receiving is theoretically fairly close to the same.
Mm-hmm.
And, if a wholesale lender and if Fannie and Freddie allowed it, said, I'm going to do every single loan, we're going to accept Experian only.
Right.
What do you like? Do you think that is a positive, a negative, something that wouldn't be beneficial, or is it just a misnomer on our part that the information that the 3 bureaus are receiving is fairly close to the same?
It's a great question. I mean, who reports to all 3 bureaus altogether? I mean, the mortgage companies report to all 3 companies mostly. Credit card companies report to all 3. The ones that don't report to all 3 are typically the negative, the derogatories. The collection companies typically don't report to all 3 bureaus. So I think if there's some sort of change in the system where all the collection companies are all going to be reporting to 1 or 2 bureaus, then you'd have a very similar, report. But if you're only going to pull 1 bureau, you're going to miss, you're going to miss some of the collections, I guess I should say. So that would be a negative. So some changes would have to take place. I think if you want to know 1 bureau or 2 bureau, we'll deliver whatever the industry needs, what the industry wants. It'd be nice to pay 1/3 or 2/3 of the report fee you're paying now, obviously. So, but yeah, if the collections
You said in Vantage Score doesn't report collections at all, correct?
Well, Vantage Score is just a score. They take the information the bureaus have. So the bureaus have, yeah. So they don't, the information that the bureaus, Vantage Score is only going to take into account the collections. They will take collections that have balances and weigh that in their score formula. If it's a 0 balance, though, they will not count that in the score formula from what my research has shown.
Okay.
So, but yeah, I mean, if the derogatory part of it could be consistent among all 3 bureaus, I think, that's fine. But that would be a huge problem at this point with taking away all 3 bureaus. From what I look at, I look at reports all the time, and that seems to be the case where 1 score is higher, 2 scores are much lower because some of the collection companies are reporting to 2 bureaus. Right. Because it does cost, I think sometimes it costs money to report to the bureaus. So which would be a reason they only do 2, but they know you have to have a mid score. So they report to 2 because that's going to affect at least the mid score if it's on 2 bureaus.
Right.
So if there would have to be some changes taking place, but that's a good question.
But I would think from, if they knew that a single bureau could be pulled, that it would be in the collection company's best interest to report to all 3.
Yeah, these are decisions that I definitely don't make.
That neither you or I are making, right? Gotcha. Well, it is 1 p.m. and I greatly appreciate you taking the time to share all this information with us, Jason. As I mentioned, this will be posted on the Hive later this afternoon. Please feel free to reach out to Jason if you have any questions, and I'll also put this information, his contact info, within the summary part of Hive, so it'll be there as well. So thank you so much, and please join me next week. We have Todd Duncan, who will be on our weekly Success Builder call, so very excited to have him join us, and I really look forward to seeing everybody again next Monday and hope you make this week a success.
Thank you, NAM. If you're not a member of NAM, you should join in. I appreciate you, Valerie. Thank you so much.
Absolutely. Thank you. Appreciate
Thank
the
you.
plug.
Thank you, everyone.
Thank you.